Hello, everybody, and welcome to my webinar for mortgage financing for business owners. So this was one that was requested by a couple of people, and so I decided to put this one on to really help you understand what the mortgage options are as a business owner and what goes into some of the challenges that you deal with as a business owner. So I wanted to really dive in. I've got some people live on Zoom. I've got people watching live on Facebook. So if you are watching live on Zoom, then you can post your comments into the Zoom chat. If you're watching live on Facebook, then feel free to post your comments into Facebook, and I'll try and pay attention to those comments. I'll see them more likely on the Zoom chat than I will be on the Facebook chat. But either way, I will be here to answer your questions. And if I don't get to your questions on Facebook during the live meeting, then I'll get back to them afterwards and be able to help answer your questions as we go forward. So let's go ahead and dive right in. First and foremost, why is it hard? I get this question all the time. Let me move my head over down there. All right. Why is it harder for me to qualify than my employees? I had a conversation with somebody just a couple weeks ago, and he said, John, I'm just thoroughly confused because I own the business and I'm trying to buy a home and I'm getting put through the ringer and I make a whole lot more than what my employee earns. Why in the world are you guys putting me through such a harder process than what my employees are going through? And it's simple. Your employee's income is predictable and stable. That's kind of why they love the fact that they're an employee, because they know exactly how much money they're going to make. And the truth is, most of the American population is not crazy enough to work with no safety net, have no guaranteed income, but you have the opportunity to earn an unlimited amount of income. And that is the challenge that people are dealing with is, are you stable in your monthly income? And for most business owners, your history says that you're stable, but I've got to prove that history and dive in pretty deep into it. Otherwise, I'm dealing with the concern of what's going to happen next month or next year. Your employees don't have that concern. Other than the fact that technically you could lose your job, it's expected that if you just perform what you're supposed to perform, we in the mortgage industry expect, yeah, you're going to keep your job. And if you lose this one, you can find another one to replace it. As a business owner, it's not that simple. It's not as though if you lose your job, it's so simple to replace it with another one. That's why your employees have a much easier time getting a loan than you have. All right. So how do we look at your income? That's a question I get a lot, is what are you guys looking at when you're trying to qualify me for a mortgage? How are you counting my income? And the truth is, it's pretty straightforward, but COVID made it a bit more complicated. What we're looking at is we're looking at what do you make annually? Because we can't look at year to date, because as a business owner, a lot of businesses are cyclical. You have a period of time in the seasons within the year that you're going to make more money or less. And it's not appropriate to look at only one part of the year and say, well, that obviously is indicative of what your whole year is going to be. It could be a great year in profit. It could be a poor year in profit so far, but it's about what did you do in the whole year? The second reason why we look at annualized income is because we look at what you filed on your tax returns in most situations. What you end up having is somebody that says, oh my gosh, John, my income's up significantly this year. I've generated twice as much revenue this year than I did last year. Yeah, but what are your expenses? Well, my expenses are 3 times as high. Then you didn't make any more money. Just because you brought in more revenue doesn't mean you kept more profit. The profit is what you use to pay your mortgage payment. That's the thing that we're paying attention to when we say, what do you qualify for? Is we're looking at how much is your monthly profit. So hugely important that you look at it from a profit perspective, from what you filed to the IRS, but we're not looking at the bottom line number of what you made in profit. There's a lot of adjustments that we're making to that, and I'll explain some of that to you in a high level overview. COVID definitely created some challenges to that, because now Fannie Mae, Freddie Mac, FHA, VA, they're all super concerned about what happens when somebody's business was significantly impacted by COVID. Are they going to recover right away? Is their income going to continue at the same level it had been in 2019? What about the time that they were closed in 2020? That's created a lot of challenges. And now what we're requiring is we're looking at your income based upon what you have made in the last 2 years, but we're also affirming by looking at your most recent 2 months of bank statements that you're producing revenue on par with what you had produced in revenue previously. And we're going to get you to write a profit and loss statement for us to prove that your current revenue post-COVID is producing a similar amount of profits that you had made pre-COVID. So we definitely look at it annually, but we're giving a lot more focus into the current year's income through looking at 2 years of bank statements and the profit and loss statement. We never used to have that concern. I'd expect that's probably going to play out at least through the end of this year and maybe into next year, depending upon how long these challenges exist with COVID. But we look at it for the last full tax year and potentially the last 2 full tax years are what we're looking at. So speaking of taxes, what paperwork are we reviewing? For everybody who is a business owner, I have to review between 1 and 2 years of personal tax returns. Now, I say between 1 or 2 years. You can't raise your hand and say, John, I'd like 1, please. There's specific criteria that Fannie Mae and Freddie Mac are looking at to determine whether they want to see 2 years of income or just 1. But the hard part is it's actually a computer making the decision. And the computer gets fed information from me about your amount of assets, your amount of income, your purchase price, your equity, et cetera, and your credit score. And then when it runs it through, it says, yep, we're good with 1 year of tax returns, or no, we want to see 2 years of tax returns. Now, here's a secret that separates the good loan officers from the great loan officers. The computer may actually give us a finding of 1 year of tax returns because of the fact that you had more income input into the computer. So if your most recent year, you made $100,000 in profit, but the prior year you only made $50,000 in profit. Well, if I average those two together, that's $75,000 in profit. And if I put the $75,000 in, the system might come back and say, yep, we got to have 2 years of tax returns and you're not qualified for as much. But if I put the $100,000 of income in, the computer may come back and say, we're good with 1 year of tax returns. So it isn't as simple as just the numbers telling the story. It's about the advice you're getting from the loan officer that understands how lending works and understands how businesses and business tax returns work. I've been doing this for 19 years and I pride myself in my thorough understanding of tax returns. I actually grew up in a household, my dad did tax preparation for a living. So at 12 years old, I was sitting in my dad's office preparing tax returns. So I literally grew up understanding taxes. And I've got to tell you, I don't know many loan officers that have a better understanding of business structure and business tax returns than I do. So I'm well suited to help you navigate those waters, especially if you haven't filed the tax returns yet. That's another secret or a tip. If you have not filed your taxes yet, go get them prepared by your tax preparer and then send me a draft copy because I can look at the draft copy and I can give you some advice. There are things that I'm going to talk about a little bit further in this presentation that are going to help you to understand where we can shift the numbers around a little bit, and we can shift the numbers before it's filed. I'll mention it later, but I'll get to it now. I'll mention it now, and there'll be a slide later, and I'll skip it, which is you've got one opportunity to get those taxes right. Because as soon as you file the taxes, yes, the IRS says you can amend them, but I won't believe you. Because I'm going to look at the original taxes, because whenever you amend your tax returns, that doesn't replace the original. It's just another form saying, here's what changed and why. And we look at the original tax return as the truth. We look at the amended tax return as you trying to change things in order to qualify. Now, that's a very, very generalized statement, but that's a major truth in the industry that once you filed those taxes, it's going to take a serious good explanation on why we should believe the amended return, but you can change it before it's filed. So if you're on extension right now, you have until October 15th to file the final tax returns. Get me a draft copy first so that I can take a look and tell you, hey, if you move these things around a little bit, obviously your tax preparer needs to be okay with it. It's going to help you qualify. So that's the key, is we take 1 or 2 years of tax returns, personal always required. Business tax returns, if you are a corporation, an S Corp or a C Corp or a partnership, we're usually going to require your business tax returns. There's some situations that we won't require your business tax returns, but here's a super, super important point. You are not considered self-employed unless you own 25% or more of the business. So if it's a family business and you have a 10% ownership in the business, I don't consider you self-employed. Therefore, I don't need the business tax returns because you're not an owner, a material owner of that business. And as an employee of the business, I can just count the income that you receive from your W-2, and I don't care about the corporate income. So that's another secret on how we can avoid turning in all of the extra tax returns. I had a client a couple weeks ago that had said, hey, John, I'm not applying for the business. I'm only applying for myself. So I'm not going to provide you business tax returns. This is a personal loan, not a business loan. Well, there was a bit of a misunderstanding there because even though you're not applying as the business, we care about the health of the business because you can pay yourself whatever you want. You can pay yourself $100,000 a year wage from your business, but your business might be losing $20,000 every year. So you're actually only making 80 grand. And we have to pay attention to that. As a matter of fact, that's literally what the situation was with this client. Is I had said, hey, your business could be losing money. He goes, it's not losing money. Don't worry about it. And I said, well, I have to look at it. I ended up looking at it and the business was losing money. Now, here's the interesting part. When I dug deeper and I said, hey, how much of the business do you own? He said, I own 25%. And I said, if you're willing to sell 1% ownership in your business to somebody else, you're no longer considered a business owner. I don't have to count that business loss against you. He ended up actually realizing as they went back to the accountant, he wasn't a 25% owner, he was a 20% owner because there were 5 of them that had equal ownership in the business. So he didn't have to sell 1% of his ownership. He was only a 20% owner. And the truth is, all I had to do was get a letter from the CPA confirming that he was only a 20% owner. I never had to turn in the business tax returns. Therefore, it never became a question that we had to document why they were losing money. Again, this is all legitimate and all on the up and up because it's part of Fannie Mae's guidelines. If you don't own 25% of the business, you're not considered a business owner. I don't have to divulge the business tax returns. The next thing I need 2 months of business bank statements. I mentioned this a couple minutes ago about COVID. And COVID has changed how we view business ownership and how we view businesses and how they, not business ownership, how we view the income on business. And we have basically said, look, we are concerned that the business is being impacted significantly because of COVID. And so we are going to ask and require that you prove that your business is producing good amount of income still, even post-COVID. And we don't just need to prove that at the time that you are starting the loan, we actually have to prove that at the end of the loan process. So when you are done with the loan and ready to close your loan, we're going to ask you once again to get us 2 months of business bank statements, or maybe 1 extra month if it's only been 1 month since we started the loan, and an updated profit and loss statement to prove the business health is still maintaining the amount of income and profit that we had qualified you at. Too many variables going on right now, gang. You know, unfortunately, with all of the issues that are going on with COVID, businesses are opening, they're closing, they're not producing the same revenue they had before, and that's a major concern to the mortgage industry. And as much as we all expect this to be temporary, it is the law of the federal government when it comes to mortgage lending that we have to prove that you are currently producing enough income in order to qualify for the mortgage payment. So it's really, really important. Kind of frustrating, but super important that we're able to verify that right now. Profit and loss statement is required because of COVID. Normally, we don't require a profit and loss statement on most loan programs, but COVID is requiring it, and you've got to have the profit and loss statement from the date of the last ending tax period. So if you're on extension right now, your last ending tax period was actually December 31st of 2018 because you haven't filed your 2019 taxes yet. Now that might be a good thing because maybe your 2019, you don't want to show the full numbers. You got a great 2018 and you want to show you don't want to divulge the 2019 income taxes. You don't have to. Right now, you can still do a mortgage as long as we close before October 15th, and you can be on extension. We're simply going to use the 2018 and 2017. Now, we're going to ask you for a P&L for 2019. We're going to ask you for a year-to-date P&L because we've got to prove that the income, at least on the profit and loss, is showing stable income. Maybe there's some unique thing that you're doing with your income in 2019 on the taxes that you don't want to divulge. I don't care. The point is you can go up until October 15th without filing the current year's tax return, and we can use the 2018 and the 2017 and just get a profit and loss covering that period. And then here's another thing that kind of frustrates business owners. You've got, let's say you're owner of a corporation, you pay yourself on a W-2, but a lot of people just don't pay themselves on a W-2. They pay it at the end of the year, but you're not doing real payroll. The problem is, in our eyes, you are. You're taking a paycheck and a draw, and yeah, maybe you write yourself a check every couple of weeks or every month, but we've actually got to show that on your pay stubs and your W-2s. The government requires that you're documenting it, that you're showing your withholdings coming out of there. We have to see the paycheck stubs and the W-2s, even though you don't pay yourself the same way as you pay your employees. We've got to show the paper trail. So sometimes it means you have your bookkeeper create the history of the pay logs and show what the income was going to be. Because the truth is, you may take a distribution periodically, and then at the end of the year, you just show it on a W-2. I had some clients that do it that way. I'm not a bookkeeper. I'm not a payroll specialist. I'm not telling you if that's appropriate or not. What I am telling you is if you're a corporation and you are paying yourself a wage, I have to see a paycheck stub and a W-2. That's a mandated piece of the paperwork. Now, a lot of people ask questions about what am I looking for on a tax return? So let me spend a couple minutes going through what am I looking for on the tax return. First and foremost, we are looking for your net profit or loss. Whether you're a sole proprietor and I'm looking at just your Schedule C, I want to know how much income the business is producing, and I need to see that on the tax return. One of the really good things we look at is depreciation. So depreciation is something that we get to add back into your profitability. So if you have a large depreciation, if you own a lot of equipment and you're writing stuff off and you're thinking, oh my gosh, I can never qualify for a mortgage because I have a huge amount of write-offs. If those write-offs are depreciation, then you're actually able to add that back in because that's not real money, it's monopoly money. Depreciation is the reduction in value of an asset. You didn't write a check for depreciation. It's not part of your cash flow. It says you own something and it's worth this much money, but as your business uses that equipment, it's using up some of the useful value of that equipment and it's depreciating that value. You know exactly what depreciation is. I don't have to tell you that. But the cool thing is I get to add back in depreciation. So maybe you want to win with the IRS and win with me. Depreciation is one of the keys to winning because it will decrease your taxable income, but I get to add it back in to increase your income for qualification purposes. Hugely important. Depreciation is one of those cool things. Mileage. Mileage, and actually when I talk about mileage, I'm also going to talk about autos. Mileage, if you're writing off your automotive expense by the mile, the IRS actually has a portion of that mileage as depreciation. So I think it's about, what, 55 cents a mile that you get to write off. But you have two choices. You can write off the actual cost or you can write off the mileage. If you're writing off the mileage, about 24 cents out of every 55 cents per mile of expenses that you write off on mileage, 24 cents of that is considered depreciation. Therefore, I get to add that back into your income. Again, another piece. Get as much mileage as you can onto the tax return because mileage is considered depreciation. It's another key when we're talking about your tax return with your tax preparer before you file it and we're strategizing that we want, if you're really, really close between the actual cost of your expenses versus using mileage, well, your CPA is going to tip towards whichever one gives you the $1 extra. So if you're able to write off $5,000 of actual expenses versus $4,800 worth of mileage, CPA is going to say, well, let's write off the $5,000. Why do we want to leave $200 of write-offs on the table? I'm going to tell you, go the other way, because you left $200 of write-offs on the table, but almost half of every one of those dollars I get to add back in because mileage is made up of depreciation component. That's a key piece that from a tax strategy planning, you can add mileage on better. Adding mileage is better than adding the actual cost that you have incurred. So another super important thing as you're talking to your tax preparer is talk about, hey, if it's close enough, let's go with the mileage instead of the actual expenses. Amortization. Amortization is kind of like depreciation. It ends in ation. Okay, there's another reason why it's like depreciation. Amortization is not a true cost. And so amortization, you're not writing a check for that. It's an expense you get to write off. We get to add it back in. Casualty loss. If you have a large business loss, it's a one-time expense. A lot of one-time expenses, we get to add back in as part of your income. So if you've got same thing is, by the way, if you have a loss carryover, this is one that blows the minds of many underwriters and lots of loan officers, is if your business has lost money in prior years, there's a cap on how much the IRS lets you write off on your personal tax return. And so it's called an NOL carryover, a net operating loss carryover. You've lost money on your business. You couldn't get rid of all of that loss. You couldn't account for or take credit for all of that loss. It becomes a carryover. What the banking industry does is looks at that and says, well, that isn't representative of this year. That was an old year when you had a bad year. I get to ignore the net operating loss carryover. But most loan officers don't understand that. They're going to see it on your tax return. They're going to freak out. They're going to say you don't qualify. They're wrong. So net operating loss, we get to add back in. Casualty loss, you have a one-time break-in, a fire, it burns down equipment, whatever, that all is a one-time thing. We get to add back in that loss. Here's some of the things that are bad. Notes payable in less than 1 year. That's a bad thing, because it basically is saying if you have a mortgage or a note that is due in less than 1 year, remember this was last year's taxes. Therefore, at the end of 2019, if you had a note due in the next 12 months, that means that the year we're in, you're supposed to write a check to completely pay off that note. Well, that means you're not going to have the cash flow this year that you had last year, because you got to write a check to pay off that note. And what the industry looks at is says, well, then we have to subtract that from your income. But here's a trick. Here's a secret. I don't know what, but here's what most of my peers don't understand. If you have a business line of credits, most business lines of credit are actually 1-year loans that are renewed every single year by the bank that holds your business line of credit. So technically, every year, that line of credit is due or payable in less than 12 months. But the rules say I'm supposed to subtract that off of your income. But if I got a letter from your CPA confirming that that dollar amount is a business line of credit that is renewed annually, I don't have to subtract that from your income. Again, another reason why a lot of lenders say, no, you don't qualify. But because of my good understanding of the banking world and of tax returns, I'll tell you, yes, you do, because I get to add that back in. I don't have to subtract the notes payable if it is based upon a renewing business line of credit. All right, meals and entertainment. I hate meals and entertainment. When I am looking at your tax return, especially in planning, I will tell your tax preparer, decrease the meals and entertainment as much as possible. The law does not say you have to report every one of your expenses. Okay, so if you have an expense and you choose not to report that, the IRS is happy because you're paying them more in taxes. I'm happy because you're claiming more income. That's the key thing you have to understand, is sometimes we're going to decrease the amount of expenses. You pay a little bit more in taxes, but it helps you qualify for a mortgage. Here's why meals and entertainment are a major, major problem for me, because the IRS only lets you write off 50 cents of every dollar. So if you have $5,000 of meals and entertainment expense written off on your tax return, the truth is that means you spent $10,000 in meals and entertainment. And my industry says, well, we got to account for the other $5,000 that you spent in meals and entertainment, because just because the IRS didn't let you write it off, the truth is it was real money you wrote a check for. Remember, this is the exact opposite of depreciation. The IRS lets you write off depreciation even though you didn't write a check for it. Therefore, I'm adding it back in because you didn't write a check for it. But meals and entertainment, you wrote a check for double the amount you got to deduct off of your tax return. So don't write off meals and entertainment if you're trying to qualify for a mortgage, because you only get credit for 50 cents on the dollar, and I got to hit you for the other 50 cents. If you have a large meal and entertainment expense. And by the way, on corporate tax returns, it's called travel and entertainment. If you have a large meal and entertainment or travel and entertainment expense, you might want to look at skipping it or minimizing it in the years leading up to qualifying for a mortgage, because you get double dinged if you are counting the meals and entertainment or travel and entertainment. Okay, hugely, hugely important. What else are we looking for on the tax returns? We're actually looking for distributions if you, if you are a corporation. So the K1 is your form that is on an S corp or on a partnership that shows your personal income that you're then going to put on the Schedule E of your tax return. And the K1 says on there how much profit you got out of the business. That's the first line on the K1. But the problem is the IRS, excuse me, not the IRS, Fannie Mae got smart. And Fannie Mae said, wait a second, maybe the business made $50,000 in income, but the truth is that you didn't take any of that money out. You left it in the business. Now, you may think that's a good thing, but Fannie Mae says, how in the world are you going to make the mortgage payment on money that you're not taking out of the business as a distribution? And we're worried that if you're not taking it out of the business as a distribution, is it because the business doesn't have enough money if you were to have taken it out? That's the key. The key is, if I count it as income, I'm counting it because that means you can use it to make the mortgage payment. And our worry is, if you did use it to make the mortgage payment, would your business still be able to survive? So that's when we look at what's called the liquidity test. And we simply say, based on certain components of assets that are on the business tax return and certain components of liability, do you have a positive liquidity? You have more assets than you do liabilities. If you do, then it's considered the business to be liquid enough that if you wanted to take distributions, you could. But if your business is illiquid, if you have more liabilities than you do assets, then we're only going to count the profit that you actually took as a distribution. So be very, very careful. Distributions are hugely important on conventional loans. Now, FHA doesn't require distributions. I've had some clients that have had to do FHA loans even though they had big down payments and great credit, simply because they took no distributions and the business showed as if it was illiquid, and I could not count the actual profit from the business. That is a big whammy that most people don't understand, and they get nailed on. If you are, I want to repeat this again, if you own a corporation, an S Corp or a C Corp, actually C Corp doesn't matter because you're not taking distributions from the C Corp. It's a partnership or an S Corp where you have a K1. I am looking at your distributions, and if you are taking less in distributions than the profit of your business, then your business better be liquid. If it's illiquid, I can't count the profit that exceeds the amount you did take in distributions. I know that's a lot, but hopefully that makes sense. All right, so I got a lot of kind of Q&A stuff that I want to cover right now. Feel free, if you have questions, to post a question into Zoom chat if you're on Zoom, or post it into Facebook chat if you're on Facebook. But I've got a bunch of questions I've kind of put out there, and I'll answer them as we go. So do you have to review the business tax returns? If you are over 25% owner of the business, most of the time the answer is yes. There are some circumstances in which we can avoid the business tax returns, but the truth is sometimes it helps us. So send them to me so that I can look at it. I can then decide if it's not helping us, I can ignore the business tax returns, and instead I can just use your personal tax returns. I don't have an obligation to turn in all of the documentation that you have given me. I can't, I have the opportunity to look at the underwriting system and figure out which pieces are required and which pieces are not required. And if it's not required, I don't have to send it in. But sometimes it helps us. I want to have as much information as I can to help you qualify for the most income you possibly can. All right, what if I file an extension? I mentioned this a little bit earlier. No problem, as long as you didn't want to use the 2019 income. I have a great example of a client I just talked to yesterday. He owns a business. It's an S Corp. His corporate taxes are done, and his 2019 corporate tax returns look great. He made a significantly greater amount of income in 2019 than he did in 2018, but he hasn't filed the personal tax returns. An S Corp, those tax returns flow to your personal tax return. And I cannot use the 2019 S Corp return unless I'm using the 2019 personal return. He needs to file his 2019 personal return. Until he files that, even though the 2019 business return was completed, I have to ignore it. So there's an example where sometimes we want to push you to file it faster, but for the most part, if the income is enough with the 2018, I don't care whether you file or not. But once we hit October 15th, on October 16th, then we have to have the 2019s filed and I have to count them. So if there's something about 2019 we're trying to ignore, we better get started now. We better get you closed before October 15th. All right. What if my spouse works for the business? That's no problem. If your spouse works for the business, then we treat it the same way. They're either an employee or a business owner. If they're an employee, I'm taking their salary like they work for anybody else. If they're a business owner, then I'm taking their salary plus the business profit, just like how I'm looking at your income. So there's nothing really unique about that. Your spouse, we can count their income. Again, if they work for the business, it's either they're an employee or they're an owner, and I'll look at it accordingly. Here's a good one. If I'm an employee of my corporation, can you just treat me as an employee? Why do you care about the business tax returns? The reason I care about the business is because you can pay yourself whatever you want on your W-2, but you may not make enough profit on the business to actually sustain your income that you're paying yourself. And to give a kind of a finer point to that, I got a secondary question on the right. Can I just give myself a pay raise? No, I don't really care what you pay yourself in the current year. So hear me carefully here. I don't care what you're paying yourself on your W-2 or your pay stubs in the current year. I'm going to look at last year and see what did you get paid on the W-2 and what did your business retain in profits at the end. And I'll give you some simple numbers to explain it. If last year you paid yourself $60,000 a year and your business had $20,000 of profit left over in the end, then you made $80,000 for the year, and that's the number I'm using to qualify you. Now, mind you, the $20,000 in profit for the business, I've got a lot of adjustments that I am going to make to that number, but let's pretend the business side of things after all my adjustments is 20 grand. So I got $60,000 in wages, $20,000 in business profit. $80,000, that's what you qualify for. You're like, no, John, no. I've given myself a pay raise. I'm paying myself $100,000 a year now on my W-2. So take my $100,000 plus the $20,000 from the business, I'm making $120,000. No, you're not. Unless this business is producing more revenue and or less expenses, here's what the numbers look like at the end of the year. Because we have to assume last year is going to be repeated every year going forward. And last year, you had 60 that went to you and 20 that was left over after that. You pay yourself 100 this year. If nothing else changes, then you got a $20,000 loss on the business tax return at the end of 2020. And therefore, we take the 100,000 you paid yourself minus the 20,000 that the business lost. You still have $80,000 in income. Remember, we're never going to count the current year's profitability. We're only going to make sure that it hasn't declined. But we're not going to count the current year's profitability. So if you have a really, really good year going, congratulations. But I can't count that until next year. So that's the catch-22 about being a business owner. I don't care how much you're earning in profit this year. I don't care how much you're paying yourself in profit this year. There is one caveat to that. Technically, we can count the current year if you got me an audited P&L. None of you are going to do an audited P&L because it costs thousands and thousands and thousands of dollars to pay an auditing firm to double check all of your bookkeeping, double check all of your receipts, and confirm that you actually made all of that income and that represents 100% of your expenses. So there's auditing firms, PricewaterhouseCoopers, whoever the heck they are, the same people that guard the winners of the Academy Awards, right? Or count the winners, whatever. These auditing firms can do an audited P&L. It is super expensive. It is super invasive. You're not going to want to do it. But technically, if you chose to, we can use an audited P&L because that is a third-party validation that the year-to-date income is in fact correct. Any other P&L is simply worth the paper it's written on. Now, we still want to get it from you because it's kind of your certification that the income hasn't dropped, but it's not going to be enough to count income increases because of the fear that A, it's cyclical, and B, it's cyclical, meaning it could have been every year the first half of the year is good for you. And B, we're worried about it's just your word, and nobody audited to prove whether or not that's actually true, and unless you had an auditor. So bottom line is, we can't just treat you as an employee, we can't just give you a pay raise, and you really can't count current year's income. Here's a good one. What if I want to run my business out of my house? There's a lot of components to that. First of all, it actually goes back to the tax returns. There's a component of your tax returns that is business use of home. That's another one of those write-offs that I get to add back in sometimes. So there are rules on some loan programs that say I can add back in business use of home, and on some programs it says I cannot. So one of the things, if you know me at all, you know that I'm a firm believer that the brain is for processing, not for storage. And this is a great example of where I don't memorize which programs require us to or allow us to add back in business use of home versus prohibit us from adding back business use of home. But what I'll tell you is I know for sure some do and some don't. And if it applies to you, I'm going to look it up every single time and make sure. But if you run your business out of your home, you're able to take a tax write-off for the fact that you are using the business as the home office, but it can sometimes help you and it can sometimes hurt you on the taxes when we're looking at qualifying you. The second thing you need to be worried about when you're running your business out of your home is what's called mixed use. Is this really a commercial property that you happen to live in, or is it a residential property that you happen to run your business out of? That's a fine line, but residential mortgages cannot be done on business properties. So if you own a trucking company and you buy a 10-acre property and that property has a shop on it, and you end up putting a mechanic in that shop to fix the trucks, and you've got 14 trucks parked on that property and everybody's coming and going all times a day, that's a business property that you happen to live on. We can't do residential lending there. If you happen to, you're a realtor and you work out of your home office, obviously that's a residential property that you happen to run your business out of. And there's a lot of fine lines in between. It's really up to the appraiser, and it's up to our looking at your income and getting a feel for what type of business you're in. It becomes even more complicated when you're actually producing income from the home itself. And what I mean by that is, if you are a vintner, if you're any kind of agriculture world, and you are growing some kind of a crop for profit on that land, well, now is that a commercial or agricultural property that you happen to live on, or is that a residential property that you happen to have all your stuff planted on? That is a very fine line, and it's just something you need to be aware of on a case-by-case basis. All right, can I amend my tax returns to qualify for a higher price? I mentioned that earlier. The answer is no. You can amend your tax returns, but we're going to look at the amendment and what you did. Now, let's pretend that you had a 1099 from another supplier that you forgot to list on your tax return. Absolutely, you can amend your tax return because you're showing more revenue and you got proof. Here's a 1099 that I forgot to put in there. No problem. We can use that, no problem. But if you said, oh my gosh, I goofed up on my taxes and I didn't mean to put meals and entertainment. I didn't have any meals and entertainment, because I told you earlier, if you missed it, meals and entertainment is a bad thing. You can't just delete the meals and entertainment by amending the tax return, because if you had it on there as an expense in the first place, it was likely an expense. And we believe as an industry that you're just amending it in order to qualify. We're not going to let you get away with amending your taxes just to qualify. So make sure it's filed right the first time. My favorite season of the year is the first 3 months of the year, 4 months of the year, because that gives me the opportunity to help you structure your taxes appropriately so that you can qualify for the most amount of money before the taxes are filed. And I told you earlier, often we only need 1 year of tax returns. We can use the year you're filing now. Think about this. If you're on extension right now and you're about to file your tax returns, you need to show me those taxes before you file them. Because if we fill out those taxes appropriately, maybe you have to show less expenses right now and you got to pay a bigger tax bill right now, but you only have to do it once, because maybe we can get you qualified with just 1 year of tax returns. Now you file that tax return, you qualify for a house. We know that next year, you have literally until October 15th of next year to use the 2019 taxes before you have to file 2020. And maybe when you file 2020, at that point, you're going to show more expenses. That's fine as long as you own the home by that time. Just be careful if you want to refinance down the road. We're going to use the same equations of looking at your tax returns to confirm that you qualify. And I have a lot of clients right now that are frustrated They're frustrated because rates are super, super low. If you don't know it, rates are super, super low. Yesterday, the Federal Reserve confirmed they plan on keeping rates super, super low. For most of my clients, we're in the mid 2% range, 2.5 to 2.99 on average. So rates are super, super low. But if you lowered your expenses in order to qualify when you bought that house 2 years ago, and now you raise the expenses back up and you don't show very much profit, you're going to be hard pressed to refinance right now. Hopefully rates stay low through next year. You need to talk to me next year when it's time to file your taxes. We make sure we structure your taxes appropriately in order to qualify for the mortgage. And then we get you the refinance with amazing rates like we've got right now. All right. Are there ways to avoid using tax returns in qualification? Yeah. First of all, there are bank statement programs out there that we look at your bank statements and your deposits into the bank over the last 12 or 24 months and treat that as your income. And then we use your profit and loss to figure out your expense ratio, and we apply that expense ratio. Guys, these are not traditional Fannie Mae, Freddie Mac loans. These are high risk, high interest rate loans. It can be done. It's not as bad as going to Guido, the loan shark on the corner, but you're not getting market interest rates. They're not backed by the federal government. They're not market interest rates. We can do them, but I don't do them very often because we're just better off structuring your taxes appropriately and moving forward from there. What if I started a new business? How soon can I buy? So that's a trick question. The rules specifically say that 2 years of self-employment is preferred. Did you catch the word preferred? Because it didn't say required, it said preferred. 1 year is acceptable under certain circumstances. Now, those certain circumstances vary. I'm not going to get into what the circumstances are, but don't let somebody tell you that you always have to wait 2 years. You have to have at least 1 full year of tax returns filed. But if you have 1 full year of tax returns filed, come to me and let's take a look. The worst case scenario is we do some planning. We make sure, because there's 3 things I care about when you do a loan. I care about your income, but I also care about your credit and I care about your cash. And so when we look at that, we're looking at, do you have enough income? Well, maybe you don't because we only have the 1 year of tax returns. But I had a client that, I will never forget this story. It was like 5 years ago. And maybe even longer than that, maybe 10 years ago. Anyway, she had been waiting and waiting and waiting to get enough income on her tax returns to have 2 years of income on her taxes to qualify. Now, she knew me, but she never had me look at her taxes. She had gotten this advice from somebody else. She finally came to me and said, John, it's time to buy a house. I've got the income that I need. I want to move forward now because I've got 2 full years of taxes. The guy that I talked to last time said that's what I needed. Let's go. And I sat down with her and I pulled her credit. And her credit score was super low. And she was shocked and she was devastated. And she said, John, I don't understand. I don't understand because the guy told me 2 years ago that all I needed to do was get 2 years of taxes showing this amount of income and I would qualify. And I said, did he pull your credit? And she said, no. I said, why? Did he offer to pull your credit? And she goes, well, I told him my credit was fine. And I said, okay. Well, there's nothing we can do to go back and change the situation. Unfortunately, it's going to take some time to fix your credit, and the things on your credit score, they're going to take about a year to fix. She broke down crying. I mean, I was devastated for her. That's why we have to look at everything up front. Even if you've only been self-employed for 1 year and you're thinking, I got 1 more year to go and then I'm fine. That's only the income piece. You've got the credit and you've got the cash piece. What if all of your down payment money is tied up in business funds? Sometimes we can use business funds for down payment. Sometimes we can't. There are so many things you need to look at. You need to have me take a look at your entire package, rip the Band-Aid off, open the kimono, show me everything so that I can help you figure out, if you don't qualify today, are you for sure going to have every issue resolved? Because there are some issues that we don't know about until we look at all of the options. We got to look at your cash, we got to look at your credit, we got to look at your income. So don't feel like you're wasting my time or yours if you come to me without having 2 full years of tax returns being a business owner. Sometimes we can make it happen with just 1. Sometimes we need 2, but it's still a good idea because we looked at the credit and the income as well. Can I use business funds for down payment? Hey, I think I was just talking about that. Here's the deal with using business funds for down payment. In general, the answer is yes. But we often will need the CPA to confirm that your business is healthy enough to continue, even with that money being withdrawn. Our concern is, what if you need that money in order to operate your business? You need that money to buy goods and materials for your business. And now you liquidate all that money out of the business. How are you going to buy materials for your next job? How are you going to make payroll if you liquidate all that money out of your business? So it is a major concern for us. We used to have a bigger issue with it. It's kind of not as much of an issue as it used to be, but it still is something we have to be aware of. And the other thing to be concerned about, I mentioned earlier on in the webinar, that if you don't own 20% of the business and you're not considered a business owner, that also means you can't use the business funds for down payment, because they're not your money to use, because you're not a material owner. You don't own at least 25% of the business. So little things that can make a difference. All right. What if my business was shut down due to COVID? You know what? It breaks my heart, all of the challenges that are happening right now in the business world and the economy with COVID, and it's devastating both from a health perspective and from an economic perspective. And I'm not here to debate the either side of that. What I'm here to tell you is just the truth. The truth is that if your business was shut down due to COVID, we have to take that into account. We have to look at, what is the future of this business going to look like? If you are a beautician and you are, right now, you in California, you can, or certain counties, at least in California, you can't operate, or maybe you can, but you have to operate outdoors, and you can't have as many clients waiting in line. You can't, all these things are changing. The question is, what's that going to mean for the future? What's the rest of 2020 going to look like for your income? What's 2021 going to look like for your income? So when we look at averaging your income, we're going to average the months even when you were closed. And that sucks. I hate to say it that way, but it does. So when we get into 2021 and we're looking back at 2020's taxes, we're going to look at, hey, you only produced 6 months worth of revenue. You produced half the amount of revenue you'd produced previously. Well, yeah, John, my business was shut down for 3 months, and then it took me 3 months to get it back up and running with all the rules that they required. Well, I know, but unfortunately, the system's worried about, is the most recent year indicative of the future? That's the only thing that we can plan on, is the most recent year being the pattern that things are going to continue going forward. And therefore, we have to look at the most recent year as fact, especially when income is declining. If income's increasing, and we require 2 years of taxes, we're going to average the two. When it's declining, we're going to use the most recent year. So unfortunately, if your business was shut down due to COVID, we're going to need the 2 months of business bank statements to prove that your business is back up and running and producing income similar to what you had produced in prior years. And we're going to need a profit and loss proving that you have enough profit this year, annualized. So for 6 months through the year, then you'd have to have at least half the amount of profit that you had made last year. So that's an important thing. The next thing I want to cover, again, so on the COVID light, is the SBA loans that are out there right now. So PPP, as a matter of fact, I read this week that with the HEALS Act, I think that's what they're calling it. You got the CARES Act that came out in March. You got the HEALS Act that's coming out right now, and they're talking about a second round of PPP lending. So the PPP loan, the Paycheck Protection Program, the PPP loan, in our eyes, is considered money that is not having to be repaid. So if you're getting a PPP loan, we're okay with it. We don't care, because we don't need to worry about repayment of that money. But SBA has another program. It's the program that when you go to the SBA website, you go to sba.gov and you click on their sba.gov/disaster. And they have a grant program where you get up to $10,000 of a grant, $1,000 per employee, and that money never has to get repaid. But the grant program is step one of a two-step program. The second step is their disaster relief loan. Now, many people get the grants and they never finish the process of the loan. They just got the grant money and they're happy with it and they're moving on. But in my eyes, you have started a loan application to borrow money. Now, in your eyes, you just got a grant and you had to start the loan application to get the grant. But in my eyes, you have a loan application in process of money that you're going to get that you do have to pay back. Super, super cheap interest rates, but you still have to pay it back. And therefore, I cannot close a loan for you while you're in process of applying for the SBA disaster relief loan. You may think you only applied for the grant. You may have not given them any more of the information to apply for the loan, but you have to cancel the loan process with SBA, and I have to get documentation that the loan process with SBA was canceled if you got the disaster relief grant and you're in process, or not in process, but you haven't canceled the disaster relief loan. I need it to be canceled, or I need the loan to be funded. Once the loan is funded, then I know how much you got. I know how much your payment is. I just subtract that payment from your profits. And as long as you still qualify, we're good. But just be aware, applying for these programs can create a problem because it is debt that your business is going to owe. Here's the other thing. Fannie Mae, Freddie Mac, FHA, and VA. They've put the onus on lenders saying, guys, if somebody applied for one of these disaster relief loans, then they're basically telling us their business has been severely impacted by COVID. You need to take a second and third and fourth look to make sure that their business is actually healthy enough to continue earning income, and they're not going to be with an issue. Okay, Penny, 3.75 isn't super low, but for a business loan, 3.75 is super low. You're not typically getting 3.75 interest rates on a business loan. So it is a super low interest rate. It is cheap money overall. And if you want to get it, go for it. But it is, we still have to count the payment against you. So just be aware, not only do we have to count that payment against you, we also have to get a second look at your business, and really we're going to dig a little bit deeper because you've tipped your hands. You've basically told the other side that, hey, my business was impacted by COVID, because you had to have an impact from COVID, or at least state you did, in order to apply for any of these loan programs. So if that is the case for you, just be aware it can negatively impact your ability to borrow money through a mortgage, but I can help you navigate the waters. None of these programs have stopped any of my borrowers from getting a mortgage. We just have to address it appropriately and in a timely manner. Will I be able to qualify? I already answered that one. All right. Guys, that's it. So a lot of good information I covered over the last hour. If you're just joining, this will be available on my page as a replay. Just go back and watch it. I'll also have it on my YouTube channel, youtube.com/JohnLoanKing. I have all of my webinars on there. If you have any questions about anything at all, please feel free. Post it on Zoom chat if you're on Zoom right now. If you're on Facebook, post it on Facebook chats. Rosemary asked me, what if it's paid off? So I'm assuming, and feel free to post if you can, clarification. I'm assuming you're talking about the SBA loan, and if you pay off the SBA loan, we're totally cool with that. We won't count the payment against you because you don't have the obligation. Remember, we don't care about the PPP loan, so the Paycheck Protection Program, unless we have documentation saying you didn't spend that money appropriately. So you're required by SBA rules to spend the PPP money. A certain percentage of that has to go towards payroll. If you didn't, then part of that money has to get paid back. That's at a super, super low interest rate. I think it's like 1%. Penny, I'm sure you're going to correct me if I'm wrong, but I'm pretty sure the PPP loan, if you didn't use it appropriately, you have to pay it back at a 1% interest rate. If we're aware that the EIDL, so the Economic Impact Disaster Loan, Economic Injury Disaster Loan. So the EIDL is the loan that you get after the EIDG, which is the Economic Injury Disaster Grant. And if you took out the EIDL, the loan, not the PPP, then we have to count a payment against you. But as Rosemary was asking, what if it's paid off? Then I ignore the payment because you paid it off. It's just like if you have a car loan and you pay off the car loan. By the way, maybe you're better off paying off the car loan than paying off the EIDL. So don't go writing checks to pay things off saying, oh my gosh, John said this is going to help me qualify better for a loan. Because if you have an EIDL loan at a super cheap 3.75 interest rate that Penny posted in Facebook comments saying that isn't a super low rate, but I beg to differ. Anyway, at a super cheap by the way, mortgage rates are like 2.5 to 2.99. You're right, Penny, that is super cheap. But for business loans, it is 3.75-ish for the EIDL. Bottom line is maybe you're better off keeping the money as the EIDL and using that money to pay off some other debt, maybe some high interest credit cards that have high monthly payments on there. That will help you qualify. So don't just automatically pay back the EIDL. Use your resource. I am that resource. Let me take a look at your total income, your total debts, your qualification, your cash, your credit, and your income to give you the right advice on how you should proceed. All right, guys, if you have any other questions, I'll be here for a minute watching the chat. Otherwise, I appreciate you joining me. If you want to see what you qualify for, definitely give me a call. We'll run the numbers and really help you to make the right decision on how to best qualify you today. And if it's not time to qualify today, then we'll show you how to get you qualified down the road, because I plan on being in this industry for quite some time, and I need clients not just today, but next week, next month, and next year. So I'm going to help guide you through the process every single step of the way. So thank you again for joining me. Feel free again to post any comments in Facebook or Zoom chat if you have any comments. Otherwise, I'm going to let you all go. Have an amazing, amazing night, and holler if you have any questions. Good night, everybody. Bye-bye.